All right, let's get started. This is a reminder of your homework coming up. Assignment 1 was just sort of look at Yahoo and figure out how the site is set up. So the real part of this homework is assignment 2. And as the course calendar lays out here, the portion called assignment 2 has to be done this weekend between Friday 1:30 p.m. and Monday 6 o'clock a.m. And the reason for having you do it then is the market is closed, so you all start from the same position. It says here, after reading chapter 4, you don't have to read chapter 4 to do the homework, but the current version of chapter 4 hasn't been posted yet. This trip I have to take to San Francisco is tying up my time, but I should be able to get that chapter posted by tomorrow. And I only have about 2 more hours work to go on it. And make sure that probably on Saturday or Sunday you piece together what I've asked you to do. And then on Monday, I want you to bring it to class and give it to me. Just print out the page that you build as your portfolio and put your name on it. Or stick it in my box outside of Parsons 1261. Don't email me anything, please. And if you want to help a friend who's not coming to class and bring theirs, that's fine with me. I'm not going to actually look at them other than to scan them, because I'm certainly not going to grade 240 identical homework assignments, but I'm going to keep them because, again, you're sort of in an implicit contest where whoever has the best portfolio at the end of the semester will be given a mechanical keyboard so that you can type on a proper keyboard for the rest of your life. You can choose between a Ducky or between a Poker 3. The student whose name I forget that I gave it to last year, I'll tell you what it is in class next time, chose the Vortec Poker 3. And there's a smaller prize for second and third. So because we're doing that, at the end of the semester, I have you check your portfolios to see who's grew the most. We narrow it down to certain percentages that are possibly going to win, and then I ask those handful of people to turn in both the first and the last, and I compare it and then finally award the prize. And that happens over the Christmas break, so that's kind of an informal procedure. But I want you to do this because I want you to get in the habit of monitoring the markets to see how they perform. Now, since the last time you saw me, I posted a video of the first half of this lecture, and that was posted yesterday. So for people who are looking at this video, it's simply important that you look at that video before you look at this one. For you, I hope you've seen the video, because this won't be as easy to understand if you haven't, because this is meant to be a follow-up to that, but it's not absolutely critical that you have seen it. So let's finish off then the second half of the lecture on exchanges. Between now and the exam, I'll probably put up another 35 or 40 minute video. What I tend to do is choose the more mundane stuff that's easy to make a video about, to do things like that, and that saves a lot of class time. So I wouldn't do it, for example, for our discussion of limit orders and bid-ask spreads and all of that, because that's too important. But background information about how these exchanges were developed and how they changed. That's a perfect candidate for a video, and so that's what was done. This popped up a few days ago in the media. I forgot where I got this from, whether it was Wall Street Journal or elsewhere. And this sort of pertains to a comment I made, or a number of comments I made in the opening of the class, where we're pointing out that in the United States and globally, there's income has not really been growing for most income cohorts, except for the upper income groups. And this kind of information that we're looking at here tends to confirm that. So a lot of different ways to approach this in terms of the data. But when you take a look at the income gains since really the mid-1970s, then you can see that the 95th percentile has had substantial income gains and in fact continued the trend that was a common trend for everyone up until or between 1950 and 1970. But the median is far below and essentially flat, and the 20th percentile, the more or less poorest 5%, 20% or 1/5 of the population arranged by family income has even been flatter than the median. And the discussion we had was more about wealth than it was about income. But of course, the two are obviously tied. If you have a high income, it's much easier to accumulate wealth than if you have a low income. So we'll remind ourselves about the reality of this as time moves on. Now, in the slide that was turned to a video that I posted, there I discussed the origins of the New York Stock Exchange and the NASDAQ and how the regulation NMS from year 2005 changed everything and how the electronic markets rolled into place and replaced the open outcry markets. So that was discussed in the video, and now that's part of your background. And I ended with the discussion of market impact as a problem that has to be solved, because when you have really large traders trying to move 100,000 shares or 1 million shares across the table because they're large institutional investors, they want to do that in a way that doesn't have market impact because it works against them. And you may remember market impact is the fact that an order that large will have an impact potentially upon prices that works against the person or institution making the order. So if you're trying to sell 1 million shares of Apple because you're a hedge fund and have to get rid of that portion of your portfolio, and it becomes known that you're trying to sell 1 million shares of Apple, that even small retail traders can front run that order and take advantage of what they know will be a significant surge of supply onto the market by that company. It's therefore important that we have institutions that allow large orders to be processed without public knowledge until after they have taken place. And the video concluded by saying there's 2 or 3 different ways of doing that. For one thing, you can simply take the really large orders and break them into small orders, but that's limiting because if it's 1 million shares or so, even breaking it up produces pretty large orders. The other, though, is an institution or set of institutions that were designed specifically to accommodate this need, and those are the dark markets and the dark pools. And that's where I left off. So let's start talking about the dark markets and the dark pools. These are discussed in Chapter 2 adequately, I think, so I don't need to say too much about them. They're highly criticized by people who are critical of the markets in general because, of course, they don't share the exposure that you get from your NBBO or PBBO price structure that we went to such pains to describe in discussing the articulation of the limit orders into level 2 queues and into the depth of market queues. In fact, none of that information is exposed to the public at all. The trades that take place by dark pools are finally disseminated to the public, but after a lag of 2 weeks, all the trades actually are finally broadcast and are disseminated by the FINRA after a period of 2 weeks. And we'll take a look at what that data looks like. So who are they? And again, let's remind ourselves of their purpose. These are exchanges on the side. They don't publicly post their transactions, as I've just said. You don't see large block transactions on NASDAQ Total View. You can sit there all day. You can see limit orders sitting there for maybe 35 or 40 or even 100 shares of some stocks, and 100 shares of any given stock, if it's a stock priced above $100 a share, is a large order, but you won't see anything there for 1,000 shares or 10,000 shares or 30,000 shares ever, looking at it all day long. You will see pieces of them, though, without realizing it if they're broken into smaller trades, which is often how they deal with this. There's a large set of institutions that predated electronic markets, including in Los Angeles, Jones & Company, whose specialty it was to receive orders to break up really large blocks of stock, like, say, 10,000 shares or 30,000 shares of General Motors, and to physically trade them down to smaller trades by telephone back in the 60s, 70s, and 80s. And so these were prosperous companies that had a job of disguising the bets of the biggest traders. And they still do that. That kind of activity still takes place. Dark markets are largely what are called crossing networks, which is an unnecessarily complex term. Remember that we talked about how best bid and best ask work, and we pointed out that often the spread is only a penny. For illiquid stocks, like Nathan's famous example we use, they may be $1 or $1.20, but normally they're less than that. For stocks like Tesla, which are very volatile, on volatile days, they're bigger than a penny. They may be 30, 40, 50 cents. When you take the combination of the bid and the ask, and you take the point that's exactly between them, that's called the peg. And a crossing network is an electronic communications network that agrees to trade stocks at the peg effectively. So if you submit an order to a dark pool to sell 100,000 shares or 50,000 shares of Ford or some other stock, then it's very likely they're going to try to strike a price at the peg right then and right there if they possibly can. Everyone knowing that instead of trying to use limit orders or anything like that, let's just settle for the peg. If the arrangement is built into the structure, it's called a crossing network. And in fact, the peg is also called the cross. And these match large blocks of trade off market. So to some extent, if you can think of the spread between bid and ask being cut in half and publicized, and sort of an offer out there to say we will buy or sell at this price any large transaction, then this is sort of the electronic dissemination within that circle, and only that circle, and not to the public, of those bids and offers. And there are currently 45 of these kinds of structures that do this. Some qualify as dark pools, and others are simply, as I explained in the video, electronic communications networks that are setting up, sort of aspiring at some point to be exchanges, or at least participating in this kind of market in some way in the future.
How do they choose which peg to use?
Well, there's always a peg at any given second. And so if you transact at any given second, you're choosing the peg for that moment. Or even, I shouldn't say any given second, any given millisecond, right? There's always a peg that exists. It's always, the trading models that I use, that I design, price typically at the peg. And so I don't know what the peg is, but the model says grab best bid and best ask at the tick level, calculate the peg, set the limit order at the peg, and send it out. And it's just a little Python model that does that. So they do it on a much larger scale and probably aren't using Python to do it. Although they might be. It's not really Python that's being used, it's NumPy. So dark pools are electronic communications networks that have permission to trade dark market transactions, and as opposed to what they call the lit market, the market that we all participate in, the dark market is where the NBBO information is simply not disseminated. The SEC allows them to facilitate secret large block trades because, again, an informed market would go against the trades if we publicly knew what they were trying to do. And by example, what would you do if you knew someone was trying to sell 300,000 shares of Ford? You'd probably rush right in and buy 100 shares of it right away, knowing that you could probably turn around and flip it not long later because somebody else out there is trying to buy the same stock on a very large order. It is having market impact. You can just imagine if you're sitting there looking at the level 2 that I told you about, and all of you should have now looked at the video that shows the level 2 that I captured on that one day. If all of a sudden you saw a limit order floating around in there for 100,000 shares, it would obviously have an impact on everything else that's going on about that stock the moment it appeared. Dark pools must report trades monthly on Reg NMS Rule 605, and the data that I'll show you later is a single page out of that data for Apple that shows which dark pools traded Apple on a given day. And they account for 15 to 30% or so of the total market volume. These are not small institutions. These are institutions that trade on some days close to a third of all the stock traded. Now, a lot of people who criticize these complain that this is unfair because they get to do things that we can't see, or they get to list their quotes that we can't see. But it's kind of easy to trace in retrospect what it is they actually did, because they are required to report every last trade that they actually consummated. So you could go back and see if the trades that they consummated look like they were unfair or distorted the market in some way or another. And there's no evidence at all that dark pools do anything other than what they're allowed to do. And in fact, it's getting to be kind of an unprofitable market, apparently, where a lot of the dark pool operators are simply trying to shut down or consolidate because they're not inherently, apparently, all that profitable. This is more recent data about the dark pools compared to the exchanges from the Wall Street Journal on May 3rd of this year. And what you see here are the percentage of all U.S. stock trades executed outside of the exchange. Now, not all of those are dark pools. About 2/3 of those are dark pools. Some of those, again, are ATSs that, for example, trade within the company. Remember, I told you that you might submit a limit order to buy to TD Ameritrade, and somebody else submits a limit order to sell at TD Ameritrade. And if those two orders are matched, there's no reason for TD Ameritrade to send them to an exchange. And in fact, so long as they're willing to honor PBBO rules, there's no reason even to list them on level 2, so long as they eventually get around to doing it if it appears the orders are not going to execute. So some of this is simply representative of the interior trading that's taken place by the larger brokerage firms, but most of it is in fact dark pools. Now, if you take a look at dark pool literature, they widely advertise, and so the New York Stock Exchange Euronext dark pool is called Match Point. And if you take a look at their literature, I'm not asking you to necessarily do this, but if you're curious about it, go ahead and see what they have to say about their trades. Then it's very obvious that they're merely crossing points, which are very elementary in what they do. Again, you take at any given moment the spread between the bid and ask and cut it in half, and that's what you trade at. And if you basically you've got an offer and the opposite, the bid, out there at the same time at the cross all the time if you're trying to move 10,000 shares or 20,000 shares or 100,000 shares. So it's not exactly mysterious as to how this works. Now, what's interesting when you look at the data after the trades have been done, which I do all the time because I'm trying to figure out, given their market size, if there's a way to detect that they are active in the market, in which case it would be like knowing that they were making large transactions. And I've, by the way, found absolutely zero evidence that you can tell that they're active in the market in a way from which one can profit. No matter what you scan for, it doesn't really seem to show up as anything that is useful information. So I look at this data to see when days were active and if there's anything in that day that might have indicated that these big trades were going on, and find nothing. When you look at this data, this is kind of probably hard for you to read, although the book version of it is perhaps a little easier because I have that in a, I think if I recall, a half-page display. This is simply the week of August the 26th, 2019, and this is the dark pool trades for Apple arranged by the Trading Corporation. And you can see that UBSS, the United Bank of Scotland, is one of the larger dark pools that trades Apple with very large trades. But and you see quite a bit of trading taking place in Apple, 1.5 million shares for that week. What's interesting, though, is when you take a look at the breakdown of these shares with the transactions divided into them, the average transaction size for a dark pool is well below 200 shares per trade, no matter who you're looking at. So you'd say, oh, aren't they supposed to be 20,000 shares or 30,000 shares and the like? And those kinds of trades do take place. But the answer is no, not if it's done by UBSS or Crossfinder up there, which is a well-named ATS, I guess. You can just take the trades and divide it into the shares, and you'll see total shares 5 million, total trades 44,000. So the average less than 100 shares per trade. So some of them are odd lot, and that means for the largest part, what they do is they break it down and then wait for smaller orders to come in, and they just piece them out all day long at those prices. And a lot of the orders they accept would be orders maybe that you would send from Robinhood, because those orders are routed directly to market makers, including dark pools. And if it's a 50-share order, which is an odd lot order, then fine, there it goes. It was used to satisfy some little tiny component of this effort to unload Apple, unless you're buying, in which case it was the other way around. And so because of the reliance to some extent upon odd lot orders, the average share size does even add up to 100 shares. But you'll notice also that some of the traders down there, including the all-important, always impressive Instanet, which you may remember was established in 1970 as a large block trader, they trade only large blocks. And so those two arrows down at the bottom, one of those is to Instanet, and the other is to LiquidNet, which is the other large crosser. And so the average Instanet trade is 15,586 shares, and the average LiquidNet trade is 10,300 shares. So Instanet still trades the way they used to trade, which is to line up really large, big block trades, probably by telephone still, and saying, okay, we got something out here. We got a lot of Apple out here. We don't necessarily say how much we have, but if you're interested in buying Apple, we're selling Apple, so call us. Call them up and they say, well, how much are you trying to buy? I'm trying to buy 6,000 shares. Well, okay, let's settle on a price. Let's look at bid and ask, and let's do a cross or something like that. Okay, we got a price. Are we good? We're good, and then the transaction's done. So a lot of it is still done by telephone, although Instanet, I think, still does or has always done most of theirs electronically, because obviously it can be done electronically. So when you look at the data, it's not quite as dramatic as people expect. It's not these secret transactions for tens of thousands of shares going on in the background while we treat our little 200 and 300 shares, or just like what we do for the largest part, except obviously they're chopping up their big trades into smaller trades for their corporate clients. And aside from that, what they do isn't very important and probably doesn't have much of a market impact. And there's no evidence that has surfaced in terms of scandals or whatever about these corporations breaking the law. I do cite a couple of instances where they were caught breaking their firewall rules and they were fined. And that there are so few of those for trades that are so small indicates probably that this system is quiet and works fairly well and is not being abused, despite what some of the critics say. So that's how dark pools operate. Dark pools are expanding now into the bond market, which is a new deal for them. Bonds are really being traded heavily on a global scale, and stocks a little bit less so. And bonds are an entirely different kind of market, as we'll see when we start talking about bonds in this class. We passed even, I think, the second examination. But there is now a dark pool for bonds in operation. They're trying to set it up. It really isn't established quite yet, but they're hoping to establish it. Moving on from dark pools, but still dealing with the same subject, the market impact. We need to talk about market makers and algo traders and how this market has shifted over time and why that matters. If we go back and take a look at the level 2 setup, where we had all of the prime limit orders listed, or the open book, or the limit order book, where they had all of the limit orders listed, you saw these little typically 4-digit codes of something called MPID, which stood for Market Participant ID. and that was discussed in greater detail in the chapter. Now, normally that is for an exchange, like ARCA is New York Stock Exchange ARCA, or the electronic version of the New York Stock Exchange and so forth. Some of them are obviously associated with banks like GSCO's Goldman Sachs, and GSCO in the dark pool is Goldman Sachs dark pool and so forth, and UBSS is obviously Bank of Scotland and the like. But some of them are specifically market makers or firms that have assumed the role of market makers that are actually algo traders. Now, there has been a transition, especially in the last 5 years, away from market makers playing the role that I'm about to describe to algo traders stepping in to do the same thing and pushing market makers sort of out of that market. Except, as I point out in the chapters, to some extent we're actually talking about the same people. We may be talking about Goldman Sachs, the market maker, being pushed out of business by Goldman Sachs algo trading operations or UBSS algo trading operations. But market makers had a very specific and identifiable task on these listing exchanges that are perhaps no longer being satisfied. So let's see exactly what it is we're talking about here. Now, market makers are large trading firms, or were large trading firms, that were committed to providing market liquidity, especially on the New York Stock Exchange, through bidding, buying, and selling in designated stocks, and doing it on both sides at all times. They would have an active bid and an active ask at both, on both sides, in other words. That's what I mean by both sides, a bid and an ask at the same time. And this description by example is provided in Chapter 2. So I'm relying some upon your understanding of that. They have a market participant ID, those 4-letter symbols that we showed you when we looked at the level 2 quotations, or upon the NASDAQ total view. The underwriters for an IPO, which is to say the brokerage firms typically syndicated among many, who are responsible for backing an IPO, are required to be market makers by NASDAQ for that new stock. So if WeWorks ever IPOs, whoever is syndicating that, it would be always more than one underwriter, are required to make that market for WeWorks and be a market maker for the indefinite future. And that's how all of this gets started. By the way, they have decided now to postpone that IPO for indefinitely. So we'll see if that happens. For the privilege of guaranteeing liquidity to the market, they did or had an inside edge on this device I'm going to explain, or this procedure I'm going to explain, called spread arbitrage, and defined in the chapter and explained later in this set. But high-speed traders began to take over the practice of spread arbitrage and actually do a better job of it typically, but they're not required to make the market. And what that simply means is they are not required to be there at all times posting a bid and an ask. They're posting a bid and an ask only if they desire to do so. But the market makers traditionally were required to be there to post the bid and the ask. They had to make a market even in a serious downturn, even in a crisis. And there are some significant implications to the fact that the market makers have largely vanished that may be seen or may surface in the next significant market downturn. Now, before we describe what they were supposed to do in more detail, we need to flip over and talk a little bit about what the algo traders do. Now, you probably know enough about this to realize that a lot of these big trading firms actually recruit here at Harvey Mudd, and they have for many years. Jane Street and the like every year seem to show up here, and some of them talk to me. Headland Technologies talks to me, for example. Some of them talk to the people in math. Some of them talk to the people in physics, depends upon who they know. But they're always recruiting here to pull people into these kinds of jobs. And when one uses the term algo traders, it can just about mean anything. You have to be a little bit more specific about what do you mean by algo trader when you bring this up. But generally, algorithm traders use computer programs to generate trading signals or to generate actual trades. And that's what it means. The question is, what kind of trade are we talking about, and to what extent and for what purpose are the computers actually being used? Now, pure algo trading means no human beings are involved at any level other than programming, the original programs that do the trades. The computers entirely do the trading. But there's a sort of hybridized type of trading, like the kind that I do, that's very similar, where you rely upon computer programs to do about 95% of the work, but where there is some human discretion involved in the trade. And a lot of these algo trading firms employ that as well. There is a human element at some point in the trade. And I tend to refer to that as computer-assisted trading rather than algo trading, so you can know the distinction and realize that there are some kinds of trades that are done with no human involvement. When you break down algo trading, which is too general of a term to be useful, there are two categories that we can think of, and sometimes the same firms are doing both, and they're sometimes doing both simultaneously and even with the same strategy, but not always. There is such a thing as high-speed trading that isn't high-frequency trading, and there's such a thing as high-frequency trading that's not high-speed trading. And it's a matter of degree, too, when you talk about, well, what is high-speed trading? High-frequency and or high-speed trading uses computerized strategy implementation based upon elaborate math models. In some cases, they're not so elaborate. In some cases, they're elementary momentum models that may have a little filter that an engineer would recognize, for example. Or they may be a mean reversion model that has something like the modified form of a Bollinger Band that you may have seen if you played around with stock market charting and the like. Some firms do this, but I don't think very many of them do it anymore. Most of it, though, is starts with a model that assumes differential equation defined by a Markov chain or something like that. With that assumption, you move on and develop your model. The high-frequency trading can only be done by large trading firms. The latter can be done by anyone, including large trading firms, but also small-scale individual traders trading for your own portfolio. So you can't do high-speed trading, really, but you can do computerized strategy implementation. As I say here, I specialize in developing and encourage students to develop under-the-radar algo trades using Python, working in a Linux environment. And by under-the-radar, it means that there are huge categories of trades that aren't interesting to the large firms because they're too small. The volume is too small. We could even do spread arbitrage ourselves in Nathan's Famous if we wanted to. We can't do spread arbitrage in SPY or Apple because all the large traders are already doing it using computers that are a lot faster than anything that we can put together here at Harvey Mudd. But Nathan's Famous doesn't have enough volume for them to do trading in Nathan's Famous, so we can use what I'm about to describe as spread arbitrage to do it ourselves, maybe. It's a little harder to do than I might suggest by that description, but it is certainly possible to do. Certain kinds of trades are not sufficiently large to attract the attention or interest of large trading firms. So in Econ 136, we try to probe around a little bit and find candidates for doing that. The strategies are, of course, just endless. Part of the purpose of the algo is to have your computer watching all days for anomalies or patterns that emerge for you to trade. Now, a lot of algo trading is actually anomaly trading. You simply trade, you sort of assume that the markets are working very efficiently. And if you trade in these markets with computers, you know they're amazingly efficient. The markets are. The prices almost always are exactly where they're supposed to be. And the computer confirms that millions of times a day. That option is not a penny above or a penny below, really, where it should be, given the price of that underlying security and its recent performance. But every now and then, a computer who's looking for efficient pricing will spot an anomaly. That price is way up, and so you trade the anomaly. And searching for anomalies is primarily the kind of programming where you're just harvesting as much data, running it through models about what a price should be, and setting up threshold conditions to make you aware of the emergence of a price that is violating a threshold, or if it's a true algo, trading off of that without doing anything further. And the computer itself makes the trade based upon the violation of the threshold for the algo. So a lot of the coding on this is not sort of the romance of developing a strategy. A lot of the coding is database coding and just high-speed coding. How do you reduce the latency on anything? You know, how do you shave a few seconds off here and a few seconds off there? And if you go to work for Jane Street, they may be more interested in you as an engineer because you understand microwave technology than because you understand anything about finance. Because microwave technology is the technology that Jane Street uses to promote their high-speed trading, as we'll say here in just a minute. Some of my models are daemons that run all the time in Linux in the background that monitor price and make calculations. In my case, they normally log them and or notify me of threshold conditions, but my computers don't trade on that. Someday they may. I don't have time to refine them so that because you've got to make sure they don't make mistakes. If they make mistakes, that can really cost you a lot of money. Now, to be more specific about it, we can talk about Gitco, for example, and high-speed trading. They're not the same thing, but are often done, almost always done, by the same large firms at the same time. So if they're interviewing here, they almost certainly do both, high speed and high frequency, and the actual strategy employed is sometimes both. High frequency trading involves placing and removing a staggering volume of limit orders in multiple markets, whether in equities, futures, or options, at very high pace for typically very short duration. You may have noticed when you looked at that video that I gave you to look at on the level 2, side by side by the limit order book, that it appeared for some prices the volume value would pop up and then disappear just as soon as it appeared. Maybe 2 or 3 pennies down the bid queue or 2 or 3 pennies up the ask queue. You would look at something and say, well, you know, it's 46.35 and it's not best bid, and it would be sitting there with a volume of 34, then 28, then 12, then 34 again, you know, really fast. And you say, well, those aren't transacting because they're not best bid or best ask. So this isn't orders being cleared. They're only taking the orders off the top. And you may notice, in fact, that the top's not moving. Best bid and best ask are stable, a penny apart, not going up, not going down. For maybe 30 seconds or 40 seconds, it doesn't move. There are trades being made, but they're being made at that 1 penny spread at those prices, and the price is neither rising nor falling. So why is the, say, 3 cents down, why is there this volume volatility coming in and going out? And that's because all up and down that bid-ask queue, these firms are sitting in limit orders, sort of fishing, so they'll display, then they pull them back out 600 microseconds later. And they send them back in and pull them back out. And so they are using internal algorithms based upon volume to try to place orders here and there so that they catch something as the market moves. And the strategies are fairly elementary that they're using to try to do that, but it simply requires this structure to come in and come out. Now, I'll sort of give you an example of it. I can't show it to you like I do at Econ 136 because the market's not open. In Econ 136, we meet in the morning so we can do the lectures when the market's open, and there I can show you how to put in a limit order on Nathan's Famous to become best, or 2 limit orders, one to become best bid, one to become best ask, how to pull it out, how to put it back in, how to pull it back out, and so forth, just like they do. And so in a little Python program. So they're basically doing on a huge scale compared to this little tiny example. We'll understand why they do it here when we get to the example. High-speed trading involves using a technology that minimizes the latency associated with any kind of trade that requires high speed. So high-speed traders want to be the first to see limit orders and the first to respond. So your high-speed trader, when you see you're looking at the level 2 or you're looking at the limit order book, and you see how it's changing like you were doing visibly on that video that I posted, then they're doing it, but they're doing it electronically, of course. And if a new bid appears, then they want to be the first to see the bid. I mean, literally, they want their computer to be the first to recognize that the bid is there. Now, to give you a sense of this, I can kind of describe it to you in words. If the market was open, I could kind of show it to you. But in the interactive program I use with interactive brokers, you have to use a sync IO to gather up the data, because what you do when you ask for a bid with interactive brokers with a computer program is you create a variable that is a bucket that is empty. It doesn't have a nan in it or a null in it. It's just an empty bucket. And so as soon as the first tick comes along for a new bid, it falls into the bucket. Then you are told that that is the bid. Do you understand what I'm saying? So you're not saying what's the stale bid that was the last bid made. That's not relevant anymore. It says what is the next bid to come along, even if it's the same as the stale bid, right? So like I say, your program creates this little bucket. It's like a variable that's sitting there as a bucket, right? And then there's some latency as to how long it takes for the next bid, the next limit order that is submitted to fall into it. Then it tells you, hey, we got a bid here at 45.11. Then you can act on it if you want to. See? Well, it doesn't do me much good to act on that bid if I have some reason to act on it if it's 45.11 and we have to do it right now, because of course it takes a long time for that bid to fall in my little bucket, even on my fast workstation in my office, right? Gitco has their little bucket collectors on the second floor of the exchange in Chicago with a fiber optic connection to the same machine that sent out the bid to me, and they get it a few milliseconds before I do. And so they can act on it and be done with the transaction before my little bucket ever gets evidence that that's the new price, see? And so they literally try to cut the speed at which these orders are captured, and then the return orders are sent back to the absolute minimum. Now, if you understand how spread arbitrage works, it'll be easy to understand why this has to work this way. You have to be the first actually to act on this stuff. So we'll try to do this by kind of a slow-moving example where I can't unfortunately show you the actual market because the market's closed and not dynamic. Otherwise, I could show it to you. So the technology that allows this class of trading is extremely expensive, which is why you can't do it. So only the largest of trading firms can afford to. So we're talking about Gitco, Jane Street, Headland, Citadel, and many of the large bank trading subsidiaries like Goldman and the like, JP Morgan. And they recruit here. They don't all do this kind of trading exclusively, but they do it. Any trading firm that is identified as a market maker or has a market participant ID is typically in this group. Now they program, of course, in C directly, in C++, Java, and specialized languages like OCaml. But a lot of this increasingly is actually done in Python because it's being done in NumPy within Python, and NumPy is just as fast as C for doing at least array operations, which is often what you're doing because you're running the data through a model to say, hey, this is overpriced. Remember, you're looking for anomalies. To know if it's an anomaly, you have to run it through a model to see if it's priced properly. And the model says, nope, that's not right. That's way off from where it should be. So a lot of that's array processing. So you can do that in Python increasingly, and it's kind of making its way even into the higher speed stuff. So you've probably seen these before. So high-speed trading relies mostly upon microwave. And this is kind of romantic, and exotic when you look at this. And so on the top, we're looking at a European to, I think we're looking at a European. European high-speed microwave network and somewhere fiber optic network. And I think that they're probably experimenting with shortwave right now because shortwave is actually faster than a microwave, with many, many limitations because it can't handle the bandwidth of microwave, but you can certainly send transmissions over really fast on shortwave. So the bottom graph represents the super high-speed network, the so-called microwave HST, Chicago, New York network between Chicago and New York. Chicago is where the options are traded. New York, or New Jersey, actually, not New York, is where the stocks are traded. And a lot of the trading involves matching, if you're looking for anomalies, matching options prices and stock prices, right? And knowing the anomalies between the two. Well, the options are traded in Chicago, the stocks are traded in New Jersey, or the electronic exchanges in New Jersey, and so you've got to get data feeds from both. Or if you're in one, you have to get the data feed from the other. So they have these hyper expensive fiber optic networks. You probably saw the movie. How many of you saw the movie about that effort to lay the straight line from Chicago to New Jersey? It was kind of a B-grade movie, so it wasn't widely. None of you saw it? I should find out the name and tell you to watch it. It's as they say, based on a true story, which means, it's probably 90% made up. But they actually did try to build that line, and they were so emphatic about having the speed being the lowest possible. They tried to do it literally as a straight line, every single place, no deviations of any kind between Chicago and New York. So they had all these really bizarre property problems of where to lay the line and stuff like that. So, but here's something, and this is don't worry, be happy. This is actually quite fascinating. So some of you may be interested in this. Read these articles. The Chicago Mercantile Exchange and the rise of high-frequency trading and high-frequency trading in my backyard. Because this stuff is all secret. So when they do it, they don't tell anybody what they're doing because they don't want their competitors to know what they're doing. So all these microwave transmission devices show up mysteriously everywhere, and people are wondering what the hell's going on. And the West Chicago Tower mystery. But what's interesting now is the suspicion that some of them are experimenting with shortwave trading. So I've always proposed, well, we should do that at MUD because it would only cost about $1,000 to set up a shortwave trading operation here, between here and, say, Chicago. Because we could buy a couple of these right here, these new digital shortwave radios, which are often used to spin like hyper-fast secret email. So if you're trying to keep the government off your back, because you're a drug dealer or something like that, and you want to send an email, you want people to get really fast, then you do it with a shortwave. And so these devices, of course, are just radios. They don't cost very much. So it's sort of interesting to say, well, what information actually would you have to send to Chicago or back to actually take advantage of the relatively narrow amount of data that you can send, of course, because you have a pretty limited bandwidth. So this is, I think, the potential for under-the-radar, small-scale, student-level, hyper-speed trading. Instead of using microwaves, just use shortwave. So maybe we can cobble together some money and try this out over the summer. Anyway, back to the difference here, okay. Now, how is this supposed to work? I have to describe this by example because I can't show you because the market's not open. Otherwise, we could literally do it like I do in Econ 133. But this is pretty easy to describe by example. So we're talking here about spread arbitrage, which is what most of the market makers do. So you hear all of this exotic discussion of the secrets of the market makers and all this and all that, and who knows what kind of magic formula that they're cooking up in their little boiling pots, and they wear witches' hats and all this stuff, and maybe call upon the Knights Templar to pass on their secrets, or they possibly simply have a system that makes sure that they have best bid. And that's pretty much what spread arbitrage involves, right? So we can use, if we wanted to do spread arbitrage ourselves, which we could do, I've got a program that'll just do it, right? We could do it in Python, and it would work. We may not make any money at it, but the Python would work the way spread arbitrage programs are supposed to work. But we may not make any money at it because there's not even sufficient volume, perhaps, for us to make money, let alone for Goldman Sachs. But here's how it would work. Now take a look at this capture of Nathan's Famous off of the level 2. This is not level 2. This is the limit order book. right? So this is the book trader, and you'll notice that I have all the books open except for New York Stock Exchange floor book, but we don't need it. I don't have BATS because BATS doesn't trade Nathan's Famous, but we're getting the quotes from all of the exchanges here on the one I'm showing you. Now, a real market maker actually doing spread arbitrage on this is IMCC, whom I have circled. And you take a look at IMCC and you see they have representation on the bid side, and you see they have representation on the ask side. They have a bid in for 67.90, and they have an ask in for way higher than that, 74.16. And they have 800 shares on bid, 1,100 shares on ask. Is this for their own account? You don't know. It may be for their own account. Probably most of it is, because not much Nathan's Famous is being traded by anybody else. And so this probably is for their own account. But it could be for a client or the like. And you see not just IMCC. You've got, you can find UBS is there. You can see it, right? And some of that's just exchange. But some of that's Valex market makers. And so all of those that have the stuff on both sides are market makers. So let's take a look at the top. And we got the bid at 70, and we got the ask at 72. And that's just a coincidence that when I captured it was even numbers like that. Now that was live during an actual market session. So those are valid numbers, and that was best bid, best ask, and those were active quotes. Okay? So then we said, well, let's do spread arbitrage. Let's submit a limit order to buy for 100 shares, just to start off small. For what price? Let me be more specific. What would make us best bid? 70.01, right? Or maybe 70.05, given this massive spread. It doesn't have to be just above. So let's say we do it we submit a limit order to buy for 70.05, right? And that becomes best bid. You understand that, right? Because it's the highest bid. So at the same time, we submit a limit order to sell for what? 71.95 maybe, or 71.90 or 99 even, right? Okay. And so if we succeed at doing that, especially if we submit our orders simultaneously, we're best bid and best ask, right? Now, if we stay in that position and a market order comes through, then one of those two sides will execute at the price we want. If a market order to sell comes through, then we will sell to them for $70.05. If a market order to buy comes through, then we will buy from them for $70 and we're bidding. Yeah, okay, bidding we are buying from them. We buy from them, for $70.05 on the bid side. If a market order to, I always mix it up in my mind, that's why you have to program it. The ask means that we have a limit order to sell. So if a market order to buy comes through, then we sell it for $71.95. So in either case, we get a price. Now, if we're lucky enough to where a market order for the other side then comes through, which is pretty unlikely for Nathan's Famous, but suppose it does, then we have sold for $71.95 and we have bought for $70.05. Right? So that's $1.95 profit per 100 shares if both of those things happen. But they don't both have to happen. Just one has to happen, so long as throughout the day we maintain our position as best bid or best ask, right? Because eventually one will come from the other side. And all day long, maybe 7,000 or 8,000 shares will sell, or 500 or 600 shares will sell, depending on the day. If we're best bid and best ask, we're always selling at a price that is $1.80 or $1.90 above the price that we're buying for. So our inventory goes up by 100 shares or down by 100 shares or up by 300 shares or down by 300 shares. And we start off, of course, with an inventory of, say, 1,000 shares so we can do this on the sell side. But so long as we maintain best bid and best ask, so long as it's us instead of somebody else, then no matter whether the price goes up and down all day long, as market orders come through, or as limit orders come through that are somewhere in between, for example, then we're able to make this enormous spread. And so that's what spread arbitrage is. The effort to maintain, one would hope, best bid and best ask, but at least periodically one or the other, and close to one or the other, and jostling for position. So we can do this manually. But do we want to do it manually? No, we don't want to do it manually. My God, what a pain in the butt that would be. It's very easy to write a little Python program that says, okay, what's best bid right now? 70.05. Okay, given, and it drops into the bucket, right? And I mean, it's super fast. Even if you're running it here in Python, it's super fast. So the best bid drops into the bucket, 70.05. So then you price out and send in a limit order that is a nickel above that. So your computer program is programmed to say, as soon as it sees the new price, to send out a limit order a nickel above it. And it will be best bid. Automatically, it'll be best bid. You'll see it pop up. Students, when I do this in Econ 136, are thrilled because we just pop up on the screen right over there on the side. It'll say NASDAQ, because we'll route it through NASDAQ, but it's us at 100 shares or 200 shares, wherever we send in at 70.05. And in the meantime, your computer is sending in an order that says, what is ask? Again, hold the bucket, wait for something to drop in the bucket, and then when it sees what's in the bucket, send a limit order in for a nickel less. Boom, we pop up on the other side. And obviously, that would be easy to do in Python. It is easy to do in Python, right? So, hey, we're going to get rich. But unfortunately, if there are two of us trying to do it in Python, it changes the whole game, right? Because as I show my students, typically, not always, we put in the order to buy at 70.05. Boom, 70.05. It's trumped immediately by an order of 70.10. Sometimes, usually, right? So then our little bucket says, hey, we're not best bid anymore. The order is 70.10. So then we say we have to cancel the 70.05, then send a new order in for 70.15, right? And so then we get trumped again at 70.20 or 70.25. So we see that in the bucket, and we say, okay, we're not best bid. So we have to cancel our order and send in a new one that's a nickel over. And if you're using Python to do this, and the other party's using Python to do this, you see the bid climb until one of you hits your threshold, say 35 or 40 cents, in 2 seconds, right? Or faster. And what's amazing sometimes is, because it shows up right on the screen, you put in the order at 70.05, the second it appears, the 70.10 bid appears right on top of it. So it means that a fairly high-speed operation is trumping your number, right? Of course, they may be just as impressed with us. They may be saying, hey, that's got to be Goldman Sachs. What is Goldman Sachs doing trading? Nathan's famous, for God's sake. But, man, they sure are fast. And that's because our little algo is working really well, and sending in. Interactive Brokers connected on one of our lines here is really fast. So we got a nice fast line running into my office and so forth. It's pretty high speed connection, right? So Ethernet connection. So we're getting our stuff out really fast, and it's a computer that's doing it, not us. So anyway, we're doing it on the bid side and the ask side, but you obviously have to have thresholds because you can't bid, because if you don't, you'll bid yourselves up to the penny spread that's seen on every other stock, wouldn't you? And that's why everything else is a penny spread. Except that it's super high-speed dynamics. So for like DIA or Apple or Microsoft or something like that, then of course this stuff is just flowing in, where in a few milliseconds, order sent in, canceled, order sent in, canceled, faster than you can even think about it because it's being done by computers. But the effort to keep the price at best bid and best ask so that you can pick up with a spread more than a nickel. You know, a dime spread's fine. If you do this all day long, you make $20, right? It's $20 guaranteed, though. It's a matter of $20. You're sitting in your dorm, you're running your little Linux box. Show you how to build for $400. It's headless. You don't need to have a keyboard. Don't need to have a screen. You can run it off of your laptop or some computer here. A little headless workstation. It's just faithfully sitting there, connected to interactive brokers, trading away on Nathan's Famous and about 30 or 40 others, making sure, however, that you have safeties on it in case it does something wrong that you didn't think it was going to do, like Knight Capital, the story that we're about to come to. And you would be a high-frequency trader and a high-speed trader, not as high-speed, however, as Gitco, because they see it falls in their bucket many, many milliseconds faster than it falls in your bucket, right? Which means we can't do it for Apple, but they don't care about Nathan's Famous. If we put in an order, it will be best bid for a few milliseconds, if not for a few seconds, because sometimes, as I show people, there's nobody there. There's nobody counter bidding it, and you get to sit there with your bid being actual best bid and best ask, right? So that's kind of cool. And if you do that, then you're doing spread arbitrage, and that's about 90% of what these big firms do, see. And they're making the market, see, because we have a bid and an ask. And that's what the traditional market maker at the New York Stock Exchange had to do. To make a market means you've got a bid and an ask. It doesn't have to be, by the way, best bid or best ask. It just has to be there. Now, the reason that's historically critical is what if everybody bails all of a sudden on you? Right? You got to stay there if you're a market maker and keep that market going. That's why the markets don't collapse. So did you understand the example I gave you about this? Yeah, just easy to explain. It's a lot more fun to watch somebody do it than it is to have it described. It's pretty easy to show. But here's the problem, see. So this is what the market maker used to do. And as often as not, there would be more than one market maker for each stock, but somebody would be dominating the spread and this and that. But traditionally the spreads, because the stocks were traded in eighths, quoted in eighths, the spreads were a minimum of 12.5 cents. These days, you know, the spread's 1 penny, but 12.5 cents is a pretty decent spread, almost guaranteed to make money. But it's harder to make money when it's at 1 cent. Did you have a question?
Yeah, I was going to ask why, I think you're starting to answer it. So.
What?
I was going to ask about back in the days when you were market makers, if kind of getting the arbitrage is profitable, but being there when it's kind of falling away is not profitable, then how come people that didn't underwrite the IPO also try to shoulder in while the market was profitable and then ditch, leaving the guy that underwrote the IPO?
Well, that was kind of a multi-question question, right? But
yeah.
The connection to the IPO is just so that there will definitely be someone who's willing to trade that stock. That's all that requirement is for. So if you did the IPO, you're one of the underwriters, and you've got to be a market maker. You have no choice on that. Okay, so that's just to satisfy, to make sure there'll be a market maker, which means Nathan's Famous has an uninterested market maker out there. The rest of it is, it's profitable to do this if you succeed in 1/10,000th of your transactions, because you're making so many transactions. So everybody out there on a large scale who does this stuff is doing it on an unimaginable scale sometimes, right? And if they connect here and there, they've done 40, 50, 60 million trades a day. And they've made some money doing that, right? So it's inherently profitable. But remember what I said, we wouldn't want to do this in Python and leave it in the dorm room unless we were sure we didn't, because this stuff can get complicated, right? That we didn't have some kind of thing built in that would cause us to make trades that were stupid, right? And that's why I gave you the example in the book of Knight Capital, because they did that and they destroyed the company, right? So therefore, all of these computer programs have threshold conditions that are pretty limiting, and it means these programs shut down the second those threshold conditions are hit. Market makers aren't allowed to shut down. They've got to stay there and make the market, see, and that's the difference between the two. This is just profitable most of the time. But if you hit your threshold conditions, it's done. And like I say in the next slide, I have sat there on bad days, and I've seen the bid queue go black, right? You see there's all these color stuff going down. What do you think is happening if the bid queue goes black? They've all shut down for the same reason at exactly the same time. And by same time, I mean same time Unix time, not same time that clock time, right? They've all shut down at exactly the same time Unix time, which means they pull out of the market, they shut down their transactions, and the bid queue is black. And oh boy, we have no foundation for the stock buying on the buy side, and that's going to be a disaster. So not all algo traders are market makers. They're required to make the market, so forth. So what happens in the next market panic? If the market makers have largely disappeared, the regulatory, and they've been replaced by algo traders, and the algo traders have threshold conditions that says we're going to shut it off if things get crazy. And they won't be there to support the market if that happens. As I say, some market makers pay for market orders routing, and this is how Robinhood survives, because they sell your order to someone who's paying for the order routing, because you make more money if the orders are routed to you, right? Like I said, maybe 1 in 10,000 transactions is working. Well, the more transactions that are sent to you, the more likely at that moment you'll be where you want to be in terms of best whatever. And so if a market maker gets a market order to buy and another to sell, they exercise these prices, and the market maker makes a penny. So if you're best bid, best ask, and you make a penny, that's a lot, actually. The transactions cost for them are zero. Their marginal cost of doing this is zero. So if you make a penny on 300 share trade, a penny per share, and you do it all day long, that's a lot of money. This is why Robinhood makes revenue, routing your order to someone who pays for it. Now, the trouble is, we've seen some evidence that this can be a problem. The flash crash of May 6, 2010 was one example. I watched this happen. At 10:42 a.m. Pacific Daylight Time, the Dow Jones fell 700 points in 15 minutes, and then it recovered in the same period of time. You don't see that very often. Procter & Gamble did what I show right there, and Accenture and a handful of other stocks fell to 1 cent. And thousands of shares were traded at a penny per share. It's because technically the bid queue went black and the prices fell to the stump price. The stump price doesn't exist anymore because of this incident, but the stump price was a price that some of these firms would put there to keep their computers actively connected to the trade. So they would have a limit order to buy at 1 penny a share and a limit order to sell at $10,000 a share. And that's a stump price. And the market fell and traded at the stump prices. They electronically, that's what happened. They fell and traded for a penny a share and the like. And so I saw it happen. A large series of Waddell and Reed computer-generated ISOs swapped off the top of a couple of key queues like Procter & Gamble. I didn't see that happen, which sent indexes tumbling and triggered circuit breaker shutdowns of algo trades, removed liquidity, depleted the ask stacks, and darkened the bid stacks, taking bids and asks to stub quotes. And the stub quotes traded. And it was ridiculous. It was such a fiasco. So they had to do an audit, and they had to go back, and they canceled out the most egregious of the trades. But they actually enforced the trades where 20 or 30% was made or lost. They didn't cancel all trades, because, that would have generated 1 trillion lawsuits had they done that. And this is one of the reasons why you don't use stop orders. I never use stop orders, because this happened to set up an automatic sale on a stop order for the iShares Core Value ETF, and it went 34% in early trading. And instead of selling it as target price, and this, by the way, was a stop a stop market order, which you never do, he had a target price of $108. The next tick was $87, and so it sold for that instead of $108. And by noon, the ETF had bounced back, and it ended the day down 4.3%. This guy lost a few $10,000 simply because he had a stock order in place. And the thing is, if the bid side goes black, then the next thing that comes along is the next tick that falls into the bucket. And if you've got a computer program that says trade at that, and it does, then you've just made your trade, right? So that's the way it works. Yeah.
One best bid and best ask are like really different, and you submit like if you submit a limit order that's really far from the best bid or best ask, what price does it trade as?
What if what?
If you submit a limit order at a price that's like really different from the best bid or best ask, what price does it trade at? Does it trade at like the price you put in or the price that?
I tried to trade this stuff, right? But I was stupid. I was looking at Ford or something, and it was down like 25%, literally, and that trade would have stuck, right? I saw my, all the bars on your screen go red down, right? I'm going, what the, nuclear war, what? And I saw Ford was right in front of me because my wife and I had bought a lot of Ford not long before on their big comeback. And I saw the price down 25 or 30% or so. So stupidly, instead of trading right then and right there for what I saw, I decided to research why the market was down. And because I did that, the price advantage had completely disappeared. But had I traded it, I would have been able to keep the profits on it, right? So that's how weird it is. So this is the flash crash. Poor pig. He invests in the market, and that blip was a market correction. You lost everything. So nobody wants this. And that's the danger of the market makers potentially disappearing. They're not there. If with market makers in place, they've got to keep that bid queue active. They've got to have prices in there. They're going to lose a lot of money when they do it, but they make a lot of money when the market's healthy, and they're required to do it. But if it's all us with our little Python or our OCaml trading programs that all have threshold conditions that say, flip off right now if you do this. Like in Linux, the command is shut down now, right? Shut down now. The computer goes black the second you hit the key, leaving whatever's running suspended in whatever limbo it's in, right? So that's the way these things do if it's going the wrong way. Now the circuit breakers, this was discussed in the chapter, so I won't say much about it. The markets as a whole are triggered to shut down with these kinds of drops for a certain period of time. Level 1 is 7% drop in the S&P 500 before 3:25 Eastern time, while it's trading for 15 minutes. These are designed to prevent panics for the largest part. They have the unfortunate effect, though, they do shut the market down. And so if you are hoping you could get back out or something, sometimes it shuts the market down. You can't get out of a position because the market shut down. Then the next day the market opens way down. Right, and so these things are not really all that much of a blessing. The market, in other words, may tumble 300 points, and you can get out of it, but you can't because they do a trading halt, a circuit breaker. Then the next morning it opens down 900. Well, it's over for you. And so then let me see. I forgot how much I have here. Nothing else. Well, I'll pick this up. Let me show you a couple things here, and I'll remember to finish this up. As the start. I went a little long-winded on the example. Okay, over-the-counter market, dollar volume. Okay, so this is the most active. This, of course, is the pink sheets. This is where you don't belong. Oh, this looks like it's pretty reputable to me. $25 a share, $44 a share. This is ranked by dollar volume, actives for the day, and say, oh, this looks like five, six symbols. That's interesting. Then let's look at share volume. Those stocks, the active leaders. Oh, wow. 4 zeros and a 1 is the price. Oh, good. There's our MoviePass company. It's still there. The company doesn't even exist anymore, but you can still buy the stock because this is yesterday's quotation. You can buy the stock. That's it right there. The shares are selling for 0.0022 per share, up 57%. Okay, and the like. These are the so-called true penny stocks, and these are the advancers, right? The ones that made a lot of money. This one went up 1,200% from 0.0013 from, I don't know, 0.00013. There's another one. This one went up 1,000%. This one, APEOF, went up 6,000% on volume of 358 shares. Well, that's not very much, right? That's 358 times 4 cents. Well, but it was Yeah, that's something, right? That's the profit he made because it was 4,000 times less than that. And there were only 3 trades. Bob, Bill, and Sue. Hey, Bob, I'll buy a beer if you buy 10,000 shares of this. So it's going to be the day's volume leader. So who are you going to sell it? Well, let's sell it to Sue. Hey, Sue, I'll buy a beer if you buy this stock. Okay. All right, so we'll come back and talk about price. The examples on limit orders, I think, is all we need to. The part of the lecture that mattered, of course, was how spread arbitrage works, and the disappearance of the market makers and all that. That's what really matters on this stuff. Okay.